Welcome to our presentation, Getting Long-Term Care Planning Right, Smart Approaches for People at All Stages. My name is Chris Holcomb, and I'm a certified financial planner with Heritage Financial Advisors. I want to thank you for your attention today to learn more about long-term care planning for retirement. After this presentation, I believe you'll be much better informed about the various ways people plan to have their long-term care paid for when needed. Let's start with a little knowledge quiz. Take a second now to read the three statements, A, B, and C, and then match with the correct answer to the statement. Your choices are 3%, 8%, and 70%. Let me read the statements while you consider the answer. Percent of Americans over 65 who will need long-term care. Percent of Americans who think it is very likely they will need long-term care at some point in their lives. Percent of Americans who have long-term care insurance. Okay, let's see how you did. The actual percent of Americans who will need long-term care is 70%. The percent of Americans who think it is very likely that they will need long-term care in their lives is only 8%. Percent of Americans who have long-term care insurance, 3%. My goal is to inform you and educate you on how critical financial planning topics affect you and your family. I also want to encourage you and your family to make plans now. We all want financial security in retirement, and when we address how to pay for long-term care, we're more likely to be able to enjoy our retirement and be optimistic about the future. This presentation is organized into 4 key areas. Each one builds on the previous one to form a solution or presentation problem. I also want to make mention that at the end of our presentation, I'll invite you to a long-term care planning overview meeting. There's no charge, one-on-one meeting that I offer so that we can discuss in private the issues raised by our presentation. I'll tell you more about it later. So let's proceed. And we want to start by asking, why is planning for long-term care important? What problem does it solve? The problem is that when it comes to planning for safe and secure retirement, long-term care remains a confusing and unaddressed challenge to many people's financial security. While many people understand the basic idea that some retirees may need long-term care, planning for it is often overlooked. There are many reasons why people put off planning for long-term care, including it seems remote and too far off. Many people think they already have a good financial plan, but it may not address long-term care. It's a stressful subject, and people don't want to think about it. A belief that Medicare or Medicaid pay for it. A misconception that people won't need to pay for care or that their family will take care of them. A belief that it's too expensive and out of their reach. Expect to just pay for it out of pocket. A belief that long-term care won't be needed. The cost and risk associated with not planning for long-term care extend to your family as well and include emotional and financial issues. On the emotional side, lack of planning may result in family strife about responsibilities and care arrangements. It's not uncommon for some family members to shoulder the vast amount of responsibility for overseeing, even giving care to a loved one. When not planned, trouble often ensues. Making late in life decisions for loved ones where cost and quality of care come into play can be stressful and difficult for your family. Many of us who are familiar with the phrase sandwich generation and taking care of an elderly family member is one daunting half of the equation. On the financial side, lack of long-term care planning can also exact the cost. There's lost wages if you're not able to pay for care and rely on them to provide much of it for you. A haphazard, unplanned approach to paying for long-term care can result in very difficult and unintended tax treatments for your money that you wanted to leave for your heirs. And of course, your retirement estate plans wishes, like helping them pay for grandchildren's education, may never come to pass if you're forced to use it all up for long-term care. To sum it up, just imagine that for a second, a picture of an 85-year-old woman trying to care for an 87-year-old husband. It's a potentially challenging situation. Now imagine that some of you are saying, whatever happens, I just don't want to be in a nursing home, if at all possible. That's a pretty common feeling, and it brings us to our first key. Long-term care isn't about an elderly person sitting alone in a nursing home. It's a range of services designed to help people with health and personal care needs. So we haven't yet defined exactly what we mean by long-term care. The National Institution of Aging defines long-term care as a variety of services designed to meet the person's health or personal care needs so that they can live independently and safely as possible when they can no longer perform activities on their own. These activities are often referred to as six basic activities of daily living. Bathing, the ability to cleanse oneself and perform grooming activities like shaving and brushing your teeth. Dressing, the ability to get dressed by oneself without struggling with buttons and zippers. Eating, the ability to feed oneself. Transferring, being able to either walk or move oneself from a bed to a wheelchair and back again. Toileting, the ability to get on and off the toilet. And incontinence, the ability to control one's bladder and bowel functions. Additionally, the care could be fully hands-on care, where the care recipient is completely dependent on the caregiver to perform these activities, or as simple as standby care to provide some assistance as needed. So who will really need long-term care? There's a widely held belief that long-term care planning isn't necessary because it's too far off and likely won't be needed. Remember the questions from our long-term care knowledge quiz. You see, only 8% think they'll need a long-term care, but that is wildly off the mark. As of 2021, someone turning 65 has almost a 70% chance of needing some kind of long-term care service or support in the remaining years. And of those 70%, 10 to 15% will need care for more than 3 years. Additionally, the number of people with Alzheimer's dementia is rapidly increasing. Between 2017 and 2030, the total number of people living with Alzheimer's is projected to increase by 35%, and the projected number of Alzheimer's cases is expected to increase by 110% between 2010 and 2050. Long-term care is provided in many settings, including at-home care, community-based care, and a wide range of other live-in options, from independent living to assisted living, with one add-on care to full-time nursing home. Often, as in the case with Alzheimer's and other degenerative diseases, full-time skilled nursing care may follow a much longer period of long-term care provided in other settings. So let's take a deeper look at these options. Well, being cared for at one's home in the declining years is one of the most common ways long-term care is provided. Relying just on extended family and friends is no longer the only option. As we know, relying on loved ones for your long-term care needs is fraught with both financial and emotional challenges. Fortunately, one can receive many services at home that in the past were provided just by family, and these services can accommodate various needs. They include part-time and full-time health aides who attend to daily living needs and household chores, visiting nurses and doctors who can participate in medical care, other support services like Meals on Wheels, which provide food and other services, necessary medical equipment that can be used at home, and case managers to help monitor the needs of the person receiving the home. While care in one's home is sometimes also called community-based care, there are other programs outside of one's home that can supplement the care one is receiving in their home. Depending on the state, these adult daycare centers may be licensed or not, depending on what services they provide. Some may provide just social activities and interaction, while others, often licensed, provide health services. In addition, they can provide needed respite care to the in-home giver, whether that is a loved one or a hired professional. As the name indicates, those living in independent living settings are primarily able to live on their own. While the term can cover those still living at home independently, it often refers to housing units, often apartments or townhomes, that are connected to a continuing care community or within a standalone retirement community. In a continuing care community, there are options to step up to more robust forms of care like assisted living, which we'll discuss next. But often seniors are able to stay within their independent living home in a continuing care facility longer than they may have stayed in their own home by adding limited support, like help with medications or some personal. In retirement communities, this additional support is often called independent living plus. In a continuing care retirement center, if the resident's needs progress or become more extensive, then move to assisted living part of the community may be necessary. Assisted living is an example of someone living with in the middle. Assisted living is an example of something in the middle, where the resident may need help with daily medication, dressing, and grooming, but still can perform some of these activities on their own. If one needs help with the daily activities of daily living exceeds what's possible with added services and as one continues to live independently, stepping up to assisted living is likely the next step. Assisted living communities provide personalized care in a residential setting. Usually these residents allowing residents to bring furniture from home and providing social interaction and opportunities to be a part of a community. While those in assisted living settings need more care than independent living, they do not need full-time skilled nursing care provided by a nursing home. Additionally, assisted living communities often provide their residents with options for meals, laundry, housekeeping, and transportation. As one might imagine, the cost for all of this can be significant. Medical costs in general keep rising, and especially for retirees as their healthcare needs increase. In 2021, the average 65-year-old would need a lifetime of $300,000 in today's dollars for medical expenses in retirement, excluding long-term care costs. And for individuals, the number is $157,000 for women and $143,000 for men. That's up 30% from 10 years ago. The median yearly national average numbers for long-term care is anywhere from $51,000 to $105,000. There are many places where those costs are far higher, for example, New York City. And in today's prices, like any other healthcare costs, these costs of long-term care and continuing to rise over time at much faster rates than the general cost of living. And I may be thinking, it's good to know that there are feasible options beyond just a nursing home. They seem expensive though, but won't Medicare or Medicaid cover this if my needs are really serious? That thought brings me to our second key in understanding why long-term care planning is a critical piece to achieving a safe and secure retirement. Counting on Medicare or Medicaid is not a plan. Most people want to rely on long-term care, and many aren't eligible anyway. In the next few slides, we'll explore the misconceptions about using Medicaid or Medicare for paying for those rising costs of long-term care. Many people incorrectly believe that Medicare will cover their long-term care costs. As good as Medicare is, long-term care is not covered by Medicare, which only covers short-term rehabilitative care that lasts less than 90 days. The key word is rehabilitative. For Medicare to pay for any services, the medical opinion has to be that the patient will recover and be able to live in a fully independent life again. Additionally, if you're covered by Medicare for rehabilitative services, it's important to understand that Medicare only pays for a certain short-term service, like skilled nursing and therapy, such as speech therapy or physical therapy, but it does not pay for custodial care, the kinds of help with daily living activities that long-term care assists. It also pays nothing for the cost of senior independent living or assisted living. Now, Medicaid is not Medicare. Medicaid is a state and federally funded means-tested poverty assistance program, and it may not cover long-term care for eligible individuals. Many low-income Americans use Medicaid to pay for long-term care, and Medicaid does, in fact, pay for long-term care services that Medicare does not. But this is all you need to know about Medicaid. You can be in for some very upsetting surprises. A key surprise is finding out that you must use up all your assets for Medicaid to pay and for you to qualify. The Medicaid applicant can only have $2,000 in assets, though your non-Medicaid spouse may keep some limited assets. Amounts vary by state. Income is also very limited in the Medicare for the Medicaid recipient, with most states capping income at around 100 to 200% of the federal poverty level. To give you an idea of what that looks like, in California, a single person can make no more than $16,000 $395 per year or $13.66 a month. While there are some income and asset protections for healthy spouse of a Medicaid qualified long-term care recipient, these protections are not unlimited. Even if you've exhausted many of your assets as you approach the need for long-term care, your income is low. What is known as a look-back period may disqualify you from enrolling in Medicaid, usually covering 5 years prior to your Medicaid application. The look-back seeks to establish if you have transferred assets to others during this time. If the assets transferred during the look-back period would put you above the Medicaid asset limit, you'll be disqualified from Medicaid, even though you no longer have the assets at the time of application. If you do qualify for Medicaid, you may still have a rude awakening. There are significant shortages of Medicaid beds with long-term care facilities of all types. Not every room in every bed in a facility will qualify for Medicaid payments. A long wait list for Medicaid beds can exist even with overall lower occupancy rates. Sometimes people do not initially qualify for Medicaid when they first enter a long-term care facility, but they spend down their assets to pay for the housing and care, then become qualified. This may sound like an okay option. There is yet one more surprise. The room you have been living in may not be the one designated as a Medicaid room, and you may be forced to move from that room that you've been occupying to a less desirable Medicaid room where Medicaid starts paying for your care. The shortage and wait list for rooms and the issue of being forced to move from a different room will become even more significant and common as the baby boomers age. By 2030, all baby boomers will be 65 or older, making one out of every 5 U.S. citizens in retirement age. Since Medicare doesn't pay and Medicaid requires you to use up your assets without any other plan option, these are very big costs that you'll have to come up with out of your own pocket. Even if your retirement planning took future non-long-term care medical expenses into consideration, which can be quite significant, you can see how long-term care expenses can eat into your planned annual income numbers in a big way. All of this is just another way of saying that not planning for Medicare can be costly and risky. So at this point, you probably get that it might be prudent to do some planning and not rely on Medicaid or Medicare. But you may be thinking, I've heard over all these years that long-term care insurance isn't a good deal at all. So are there real options? That brings us to our third key. Given historic problems with long-term care insurance, it's understandable people have avoided making a plan. Long-term care insurance is the only way to plan for long-term care. It's understandable that people avoid this topic altogether due to historic problems with the products designed to address this concern. It's quite possible that you've heard that a loved one purchased what's called first-generation care insurance, and you may, through them, have had some bad experiences with this original traditional long-term care insurance policy. The insurance was first introduced in the 70s, though it didn't really catch on until the 80s and 90s. At that time, original long-term care was introduced. There were 2 options for receiving care: nursing home or at home provided by loved ones. Concepts like adult daycare and assisted living were foreign to most people. During the 80s, the options for care started to expand, as did the demand for original long-term care insurance products. They provided a good option to the one who wanted more common ways to pay for care costs by selling their home. Many insurers had got into the business because it seemed like a good. While these original long-term care insurance policies seemed like a good idea, and they were not a hot commodity in the 80s or 90s, eventually they became fraught with problems. One of the problems was the original underwriting. The insurers underestimated both the increase in longevity and increase in healthcare costs. Unlike life insurance or medical insurance or car insurance, which you might buy multiple times over the course of your life, by design, long-term care insurance is something you buy once and likely hold for a long period of time until you need the benefits. A policyholder started making claims many years ago or decades after buying the first policy, and having paid premiums for all these years, insurance companies began to figure out they made a big mistake. What was once seemed lucrative was now understood to be a money-losing product. Though some insurance companies made good on their claim and lost money, some did not. Policyholders ran into all kinds of issues when insurance companies tried to fix their mistakes. For example, skyrocketing premiums, including post-claims underwriting that charging a new premium based on a claim that was submitted, refusals to pay qualified policyholders for benefits if they didn't require nursing home or additional custodial care, requiring hospitalization prior to covering care, and policy cancellations for reasons other than non-payment of premium. Long-term care insurance has improved over the past 25 years. Regulators enacted major reforms in 93, 96, 2000, and 2005 to provide consumer protections. These include requirements that all long-term care policies provide coverage for all forms of dementia, including Alzheimer's, and not require hospitalization in order to qualify for benefits, and not require skilled care needed in order to pay for custodial care, made language under which claims can be made clearer, do all underwriting up front, no post-claims underwriting, cannot be canceled by the insurer for other reasons except for premium not paid. Premium increases are also regulated. While these regulatory changes made newer long-term care policies more appealing to consumers, these changes were not retroactive. That means that older policies without these protections are still out there causing problems. So you may be starting to get the idea that planning for long-term care almost seems futile and out of my reach. But there's actually good news. Because of those historic challenges around long-term care, there have been a lot of changes in recent years, and the reason to feel hopeful about this long-term care. This brings us to our fourth key. New approaches to planning for long-term care addresses people's skepticism and provide a wide range of flexible options for people at all stages of financial planning and health. The new approaches to planning for long-term care are varied as the people who need them, providing a wide range of flexibility and security to people at all stages of financial planning and health. They roughly fall into a few categories: improved long-term care insurance, long-term care options on life insurance annuities, and other financial instruments and assets. Let's look briefly at each. As discussed earlier, regulatory changes led to improvements in traditional long-term care insurance. Traditional long-term care means that you pay a premium for a future claim for long-term care needs. There are no benefits outside the long-term care coverage, though the details of the benefits vary from policy to policy. They frequently have cost of living projections so that the benefit will increase over the years, protecting against the rising costs of healthcare. The next category of approaches for planning for long-term care is products with long-term care benefits. The most well-known of these are life insurance policies that have a long-term care benefit option, but they also include annuities that carry similar long-term care features. These policies are sometimes referred to as hybrids, as they provide the benefits of life insurance or annuity and the benefit of long-term care. They are very popular as they provide a benefit even when no long-term care is needed. There are many different ways to structure these policies, but in general, they allow the policyholder to draw down the life insurance or annuity benefit to pay for long-term care while they're still alive. There are a few other strategies that can be leveraged for paying for long-term care. Let's look at some of them. Equity in your home. One option is for those who live in their homes that take a reverse mortgage. This allows homeowners to draw down against the equity in their house to pay for long-term care. One downside of reverse mortgage is that you are potentially using up the equity in your home, but they usually include various benefits. Tax benefits as loan proceeds are generally not taxed. When the home is sold to repay the mortgage, if proceeds of the sale are less, then the mortgage company has to take a loss rather than being able to go after the assets of the homeowner or homeowner's estate. It usually means the homeowner cannot pass this asset on to their heirs. Another way to use the home equity in your loan is to pay for long-term care by setting up a HELOC, the home equity line of credit. The HELOC allows the homeowner to draw against the line of credit when funds are needed. Often there is no way or very minimal asset fee to maintain this line, and no interest payment if no draws are made. HELOCs have many different structures with interest only, principal and interest, payment options during a draw period, and various draw repayment terms. Cash in an existing life insurance policy for living benefits. For those over 65, selling a life insurance policy to a life settlement company to pay for a percentage of death benefit is one option for funding long-term care. The percentage received is dependent on the one's age and health status. Many life insurance policies offer accelerated benefits that pay for care for those who are terminally ill. Use pre-tax savings like IRAs to purchase protection. Retirement assets can be surprisingly substantial and a good source of long-term care needs. Using a Roth IRA or a portion of a traditional IRA or a backdoor Roth contribution for those who make much more to receive a tax benefit for Roth contributions can help create funds to pay for long-term care. Roth IRAs grow tax-free and are not subject to minimum distributions. Long-term care and discipline Long-term care and disciplined funding and use of a healthcare savings account is another way to pay for long-term care, as both the costs themselves and long-term care insurance premiums can be qualified health expenses. There are challenges and drawbacks to each of these strategies, so further discussion on them would be part of creating a plan and paying for long-term care. What about simply self-insuring, using one's own assets to pay for long-term care costs? Should you self-fund? Are you relatively young and healthy? While self-funding is always an option, one school of thought suggests that investments are not a substitute for insurance, and insurance is not a substitute for investments. While it may make sense for some people, for others it does not. Here's an example where it might not. Additional challenges of self-funding include knowing when you'll need the care, for how long. The school of thought says investments should be investments and insurance should be insurance. Invest well to ensure financial independence. Insure well to protect financial independence. As I mentioned earlier, these long-term care options are varied as the people who need them. So which factors go in to determine which ones are right? There are many. They include your age, your marital status, your health, your military service, where you live, where you intend to retire, your family history, your assets and wealth, other financial retirement planning, your legacy and estate plans. While some may feel they're too young to be thinking about long-term care, some options are best started when you're young and healthy. I recommend buying a policy in your early 50s. Others may think that you're too old or ill to make up for the lack of planning, but in fact, there are options for people in this situation as well as in between. Overall, as a good guide, here are some options you want to keep in mind when you consider long-term care. Who will provide the care? Where do you want the care, and how will you pay for it? It's also important to keep a few other things in mind. Your situation is unique. There's no cookie-cutter solution for everyone. You can receive care in your home whether you pay for it with a policy or pay for it yourself. Having a plan is important. It doesn't mean the plan necessarily has to cover all the costs. We're getting close to finishing, so let's recap. We've started with this problem. When it comes to safe and secure retirement, planning for long-term care remains a confusing and unaddressed challenge for many people in their financial security. Then we discussed 4 keys to gaining financial security through planning for long-term care. Key number 1, long-term care isn't about an elderly person sitting alone in a nursing home. It's about a range of services designed to help people with health and personal care needs. Key number 2, counting on Medicaid or Medicare is not a plan most people want to rely on for their long-term care, and many aren't eligible anyway. Key number 3, given historic problems with long-term care insurance, it's understandable people have avoided making a plan. And finally, key number 4, new approaches to planning for long-term care address the people's skepticism and provide a wide range of flexible options for people at all stages of financial planning and health. So this brings us to our natural conclusion, the solution to our challenge, and here it is. In order for you to feel safe and secure about your retirement plan, you need a custom approach, a real plan, and how to pay. We've seen a variety of approaches to this challenge. I'd like to invite you to come in for a one-on-one meeting where we can discuss what options you'd like to consider as you plan for long-term care. Developing a custom strategy on how to pay for long-term care is a smart and responsible approach to planning for your financial security and retirement. How do you get a real plan, one that's customized for your unique needs? As I mentioned during my introduction, I always invite people to come in at no charge for a long-term care meeting. You come in and talk with us as a financial professional. We can use our planning experience to help you with your long-term care and to help you feel secure about the plan and which one's right for you. Any questions?